Hi, I'm Andy Hart, CEO of Delegate Advisors. I'm here today with Ben Thompson, President and CIO of our firm. And we're here today to talk with you because we've been getting a lot of questions from clients about the economy and about the Federal Reserve and the recent actions the Fed's taken to raise interest rates to fight inflation. And so in response to all the questions we've been receiving, we thought we would start by giving everyone a little bit of a historical perspective on why we think we've been here before and how this time might be different.
We thought that the best way to approach this discussion was really from a long-term perspective. So the chart in front of you is 60 years. It's from the beginning of 1960 through today. The blue bars represent US GDP on a quarterly basis. So essentially where the blue bars are below the line, that's contraction in the US economy. Sequential declines indicates a recession. These gray bars are recession lines. The gold line is the US unemployment rate, a measure of full employment. The pink line is headline CPI. So this is the fully loaded CPI number. The green line is the Fed funds target rate. Important because of the interrelationship of these factors is what we're talking about today. So let's look at the interrelationship historically and talk about how that's evolved over time. I want to focus on three specific time periods. One is the 70s, and this is when you think about the term stagflation, this is really where stagflation gained its teeth, the Volcker era, where you had significant increases in inflation, substantial, up to 14%. And you had a stagnant economy, consumer reacting to very high inflation. And then you had a Fed that was extremely aggressive in attacking that inflation, by substantially exceeding it and driving the inflation out of the marketplace. At the same time, driving unemployment up and driving economic performance down. So essentially, a very aggressive Fed that favored price stability over all other elements. Then you can enter the 80s and the 90s. And what's really interesting about this period is when you think about the world, it's post-Volcker, so you have inflation under control, you've got generally improving employment, you've got interest rates generally falling, but you also have the fall of the Iron Curtain, you have China invited to the WTO, and you have the ratification of NAFTA, and you have significant advancements in technology, particularly information technology, as we all know. So all of that conspired to create an incredible productivity boom, right? You had cheap labor all over the world. You could move your supply chains anywhere on the globe, improve your profit margins, and take advantage of these improvements geopolitically, trade, technology, and labor access. So this really was a period that ushered, obviously, an economic boom and rallying markets with low inflation, low unemployment, and relatively low interest rates. At the end of the 90s, and we had turbulence, over-leveraged hedge funds. We had long-term capital. We actually had an Asian debt crisis first, over-leveraged long-term capital, and then the dot-com burst. And what occurred during this period was the Fed became much more engaged in capital markets pricing. And so in an era where the Fed is watching asset prices and concerned about falling asset prices, the Fed becomes more engaged in adjusting interest rates to reflect that risk. And so we became accustomed to it in the early 90s, in the early 2000s, the term Fed put came into being. And we experienced a 20-year run, really, from the dot-com bubble bursting, global financial crisis, out to COVID. And the COVID period, obviously, the Fed's action was critical in navigating the perils of the COVID period. But it also created essentially an industry of capital allocators who largely know this period. So for the last 30 years, we've had a pretty accommodative market, whether it's a Fed that's partnered with the marketplace or it's substantial improvements substantial enhancements in globalization that allow for distribution of supply chains and increasing profits, or low interest rates and low unemployment and low inflation. Today, other than technology innovation, most of the rest of that is up for question. Globalization is certainly going to be different going forward, post-Ukraine, post-COVID. Supply chain issues that we experienced, for no reason other than COVID, exposed the weaknesses of having substantially diffused global supply chains for essential items. And the war in Ukraine has reinforced sort of significant ideological differences in countries and will affect how countries trade with each other going forward. I think that's hard to argue against. For the first time in the Fed's, in most professional investors' careers, you have a Fed that's very hawkish and has the mandate to be very aggressive, fighting an inflation level that we haven't seen since the early 80s. The Fed has a dual mandate: price stability and full employment. Full employment had been a higher priority, arguably, for the better part of the last 20 years, but price stability is resuming its position in front. Andy, you have some thoughts on this?
The really important thing to remember about the Fed is they have a dual mandate, and the basically fighting inflation is job one, but also full employment is job two. And when we look at today's situation, we are at a place where we've almost got full employment, and we have sort of 1.8 jobs looking for each one worker that's out there. And so we have a position where the Fed's got a license to run on fighting inflation without really hurting employment. And so as we look at the situation we have today, the Fed seems to be in a bit of a unique position relative to the 70s. And we think that the Fed's going to continue to run on fighting inflation until they get things in hand. And until they see employment roll over, our sense is the Fed will continue to aggressively attack inflation, and who knows how far that will go. Right now, the market's anticipating, as you put it, 7 to 8 increases, maybe 2.5 to 3%. But our view is we just have no idea. But if you want to watch one indicator, watch the employment rate and see what happens as we get into a place where the Fed's really stepping on the brakes. If employment rolls over, our sense is the Fed may change its tone on inflation.
Yeah, you're exactly right. And if you look kind of at the evolution of the Fed from Volcker to Greenspan to Bernanke, Bernanke wrote a paper in San Diego, post paper in San Diego, about the risk to the risks and difficulty around fighting deflation rather than fighting inflation. And so it, to some extent, put a flag in the sand saying that the Fed is going to be more comfortable letting inflation occur than fighting deflation. Obviously, we're not fighting deflation right now, but the bias of the Fed and the focus on full employment is different than it was during the Volcker era. So even though the Powell Fed, is more hawkish than the Fed than any Fed we've seen in 2 to 3 decades, there's still that mitigator, to your point, Andy, of full employment.
So as we think about the circumstances today, the 2 other things that we wanted to cover are how to think about investing during a period like this, and what specifically are we thinking that clients should be looking to do over the next 6 to 12 months. So one of the key elements we look at in investing is the ability for our clients to sustain their investment plan during difficult times. And one of the items that I'd like to share with you is a chart that we have seen recently that shows the last 50 years of economics in terms of the market and market pullbacks in relation to the Fed and its activities and general economics in particular. What you'll see here on the top are the blue bars represent the downturns and the bear markets over the last 50 years. And the dark blue bars represent the recoveries from that. And one of the questions we're getting from clients is, when should I think about entering the market? And our response to them is, you shouldn't think about trying to time the markets because it's just not doable. Whether or not the pullback is going to be a 48 or a minus 56% pullback or a 27% pullback, we just have no idea. But if you apply some math to the thinking, if the average pullback was 41%, you need about a 60% recovery in the markets to bring you back to even. On the other hand, if you look at the runs in between the bull markets, the average has been around 227% of upside. So you've been more than adequately paid. In fact, almost 4 times the payment for the recovery required to pull back to par from the downturns by just staying invested. So our message to clients is find a level of equity risk and volatility in your portfolio that you can live with, and be sure to stick to your plan, because by far and away, the market has proven that you're well paid for taking that risk. And then the second part to it is that you should be prepared to add risk to your portfolio at some level when the markets have pulled back, because whether it's down 27% or down 56%, we have no idea. But at some point, we're going to want to see you add risk to your portfolio when prices become more fairly valued.
Yeah, and Andy, it's a great point. I think one of the important things to remember is that markets are always forward-looking. So the market is pricing in a number of factors and scenarios that have yet to come to pass. If they come to pass, the market will have priced correctly, but more likely they won't come to pass exactly as the market's priced them, and so there will be volatility as a result, upside or downside volatility. And one of the things that's pretty important to look at is what's the state of market psychology today, and what is already priced in, so to speak. There's an interesting survey that B of A does, where investors, and there's a survey of funds, professional investors. So professional investors are expecting 7.9 Fed rate hikes as opposed to 7.4 in April. Fund managers are the most underweight equity since May of 2020. Their investor positioning has turned the most defensive since May of 2020. Monetary risk is seen as the most significant risk. They're looking at the Fed to begin to intervene back in the markets at around 3,500, which is, as of today, we're about a little over 4,000, so 500 points below where we are now. And what this tells you is that there's a lot of bearishness factored in. And the question is, will the more negative factors come to pass in a way that's consistent with market expectations? Because if they don't occur as if the situation is not as bad as the market's forecasting, that's actually an upside surprise. So the pricing of today's market factors in a lot of negative things. This is also from the same survey. This is professional fund manager cash balances. When they raise cash, it means they're bearish and they're concerned. We've got cash balances raised today higher than we had in April of 2020, which is right after the beginning of COVID. October of 16 was a very volatile period in the markets. Cash balances rose back to December of 08. And this, as many investors recall, the turn in the equity market was March of 09. So these periods of significant bearishness tell you where the market's currently priced and how much bad news is priced in. So if you look at the way the markets are priced today, we have a bond market that's adjusted pretty significantly. I think everyone knows by now that the positive correlation of bond returns and stock returns in the first quarter, an anomaly normally, was pretty painful for investors. Once the 10-year Treasury rose above 3%, the relationship seems to have resumed a more normal relationship, with bonds being more of a protector against stock volatility as opposed to a partner in it. But short-term interest rates have also risen pretty dramatically. If you can invest in a tax-efficient fixed income portfolio in the high twos with 3 to 5 year security risk, you're getting compensated substantially better than you have been for quite some time. So the pricing of the fixed income markets, certainly out to a certain duration, factors in a pretty negative, a pretty aggressive Fed tightening path. Also doesn't necessarily price in much of a recession, because if a recession occurs, we would expect fixed income to fall. So, the repricing has created some opportunity and, a bit of defensive opportunity for clients who are in fixed income, which is a part of all portfolios. So the degree to which you're in it reflects your concerns or your aggressiveness. On the equity side, the markets are down 13 to 20% year to date, depending on which day you look and what's driven the headline for that day. But that's a relatively substantial amount of adjustment that's occurred since the beginning of the year. What the bottom is, we don't know, and it's very difficult to forecast. But we know a significant amount of negative information has been priced into the market at this point.
And Ben, as we've heard from some clients, we've seen a particularly large pullback in the tech stock sectors, and value stocks less so. What do you think about that?
Yeah, I think the negative returns are not evenly distributed across the marketplace. So if you look at growth versus value, year to date, the Russell 1000 growth is down over 20%, and the Russell 1000 value is down a single-digit percent. So it's a pretty significant deviation in value change from those that were the hotter stocks that drove a lot of the capital flows versus those that were, the workaday mundane stocks that were not of interest. So the headlines are obviously being captured by the mega cap technology stocks that have certainly seen the most significant volatility, as well as those companies that are not profitable. When you look at the repricing of the venture capital world, it's similar to what you see in the more extended part of the NASDAQ. So this repricing, it's a few things, right? It's a little more of reality coming back to companies that were overvalued, It's a shift in demand patterns from COVID, stay at home, lock the doors demand to go out and travel, go to restaurants, and go participate in the economy behavior. Interestingly, the consumer is the one piece that's still holding on still holding pretty strong. When you look at Walmart and Target's earnings, which were dismal according to stock price performance, they obviously saw their biggest one-day decline since the crash of '87. They both beat on the top line. They both sold more than the analysts expected them to sell, and they beat on same-store sales. So the consumer was behaving as if there are snowstorm clouds, but earnings fell because costs went up. And Target and Walmart discovered that they had built inventories of things consumers weren't going to buy as much of, and consumers were buying other things now, but yet they were still buying. The one risk in this, and this is something that obviously we're paying pretty close attention to, is the consumer's pretty heavily levered, or they're increasing their leverage, I should say. They're not necessarily heavily levered yet, but the leverage in the consumer economy is picking up. And so when you think about what's been propelling our growth, there we go. Kind of slow to load. The blue line is consumer credit outstanding. So there's a change in consumer credit. So basically, think about it as credit cards, and this is the monthly change. So if it goes up, that month credit card balances went up. If it goes down, that month credit card balances went down. The green line is the personal savings rate. So as leverage is going up and if incomes aren't changing, savings rates are going down, right? And then on the pink line, we've got the home prices. So the Schiller 20 city index of home prices to see where some of the consumer's wealth is coming from. And the gold line, which is sort of the older data series, is actually household net worth. So it's all of the equity value that a household has, less their debt, the assets, less their liabilities. So what you saw was a pretty significant increase in this gold line as you moved into COVID, right? You had increases in home values, increase in asset values, and you had a lot of it was driven by homes. Personal savings rates rose during COVID. And consumer credit fell pretty dramatically as you saw certainly less credit card usage in the beginning of COVID, and then it began to expand at a pretty robust rate. Today, where are we? We've got consumer credit rising at a pretty fast pace. We've got personal savings falling at a commensurately concerning pace. So the vulnerability of rising consumer credit, falling savings rates means that the consumer is likely to be on board consuming until they feel significant personal concerns, and that point could see a real retrenchment. And I'd say that, Andy, you've made a good point about what we don't see in all the consumer credit numbers that are public.
Yeah, I think that's coming out in articles we're reading about, and the Consumer Protection Agency has come out with a deep dive into these buy now and affirm type organizations that don't report to the credit agencies. But if anybody's bought a Peloton the last 3 years, the buy it now and affirm will give you a 0 interest loan and you can pay it off over 4 years has been the vast majority of the way people have bought their Pelotons. And none of that shows up in the credit reports until people default on that debt. And when they default on the debt, it'll then hit their credit report, but not before. So that consumer line that's been spiking up, the question is whether or not that's a lot larger or just somewhat larger, but it's a bigger number than what's reflected. So it's enough that Congress actually had a hearing on it in the last 2 weeks to decide what they're going to do in terms of trying to regulate these new free money giveaway TikTok type, plans.
Consumption drives 2/3 of the U.S. economy, and as long as we've got a healthy consumer, the capital markets volatility and the inflationary headwinds can be absorbed. The consumer, in some regards, part of the reason that we're seeing earnings challenges on the corporate side is because we're seeing wage increases, which is good for the consumer, obviously. And as we said before, the labor market, is at a historically tight level. So the consumer has a lot of confidence in their ability to find a job. There are job losses occurring, but they're occurring more in those sectors that are unprofitable, in areas that experienced rapid increases in valuation without necessarily rapid increases in profits. But how long that sustains is going to be an indicator of the consumer's willingness to sort of stay engaged, continue to behave the way they have been behaving, which is supporting the U.S. economy.
Yep. And so to come back to the other point we raised is, what are we thinking about doing over the next 6 to 12 months? Some of this is the same as we've been saying to clients all along, which is be very long-term focused, be willing to accept the risk in your portfolio, make sure those limits are set correctly for your tolerance, and then look for opportunities to add risk to your portfolios when prices are lower. And specifically in the equity markets, we don't know what the bottom will be, but we do know that as prices get to be cheaper, we're going to be coming to our clients saying, we'd like you to add more risk, and we'd like you to do so in an implementation plan that adds that risk over a period of time. On the opportunistic side, we're going to come to clients and ask them to increase allocations to sectors like secondary private equity, because we've seen time and again that during these periods when equity markets have pulled back, the secondary private equity, the buyers of older aged funds where they can see under the hood and see the companies that are owned, they have a much better way to determine what they think they'll get paid, and they'll value those according to where the market metrics are. And we have seen that consistently adding to secondary private equity, especially during periods where we think the markets might be difficult, has been a great strategy. And then the last piece is just consistently doing what we've said for the last 2 years by adding to real assets, multifamily and other types of rental properties where rents are adjusted based on inflationary premises. Gives clients a way to participate in a market that's going to benefit from an increase in inflation.
Right, and I'd say, these are secular trends that we've felt strongly about for years. They happen today to be very consistent with the inflation story as well, when you think about multifamily and agriculture and other real assets. But these are secular trends that are likely to be significant drivers of performance over time.
So in concluding, I think the takeaways from this conversation that I have are that clients should be patient, they should be long-term focused, and they should be opportunistic in taking on risk when prices become when prices drop and values are better. And then the other part is that we look for opportunities in the near term that are tied to equity market risk, because in the last few times we've seen the Fed increase interest rates and target inflation, we've seen equity markets pull back. And so we do feel that as long as the Fed is stepping on the brakes and tightening, that we will continue to see pressure on the equity markets. And as you mentioned before, Ben, some of this is already fully priced in because the market's expecting 7 to 8. Some of it's priced in, but we don't know. And so our advice to clients is be patient and be willing to take opportunities when prices fall.
To clarify, 7 to 8 tightenings resulting in interest rates, Fed funds effective rates in the 3% neighborhood. But it's a moving target, and it's really a long way from where we are today. And it's more about whether the action of the Fed meets the expectations. Because if it doesn't, the market will reprice to a new expectation.
So Ben, thanks for joining me today for a chat with everybody about what's going on in the markets and some of our thoughts. And for everyone that watched this, we would really appreciate your feedback. This is the first time we've done this type of content on Zoom to help get our thinking out to you more quickly.
Thanks, Andy. I appreciate it. It was fun, and look forward to hearing feedback, good and bad. Please let us know what we can do better. On that note, we have one last screen to share. Those of you who remember the mid-'70s and the government campaign to fight inflation, spend less, save more, and nice stickers to boot. Have a nice day.